You know that massive car dealership on the edge of town? The one with the giant American flag, unlimited TV commercials, and the owners driving around in whatever luxury car they want? It looks like the ultimate American dream. But what if I told you almost everything you think you know about how they make their millions is a complete illusion? Let's dive right into this explainer and completely shatter that illusion, peeling back the layers of a $1.3 trillion US industry to show you how they actually make their money. Here is the craziest part to kick this off. Despite all that flash and massive revenue, the average dealership keeps a razor-thin 1 to 2.5% net profit on the actual vehicles. I mean, you probably think they're raking in 10 or 15% per car, right? Nope. On a $10,000 sale, they might only clear 100 to 250 bucks once all the costs are tallied up. So the big question is, how on earth are they getting so insanely wealthy on margins this incredibly thin? Part 1. The multi-million-dollar buy-in. To even get into this game, there are basically 3 doors. And it turns out, the wildly expensive, highly restrictive franchise models are pretty much the only ones built to survive a rough economy. Down at the bottom, independent used lots are the absolute cheapest to open, but you're only looking at about $1,500 profit per vehicle, and they completely lack the massive profit engines we'll talk about in a minute. Up at the top, luxury and mainstream franchises are heavily restricted by the big automakers, but they stack multiple, highly lucrative profit streams that make them practically bulletproof. Just look at how fast these costs stack up. Opening a standard franchise demands up to $10 million right out of the gate. On day one, you're writing a massive check to the manufacturer just for the franchise fee, anywhere from 30 grand to over $500,000. By month 6, you've got to secure 4 to 8 acres of premium real estate and build a highly specialized facility. And by year 1, the manufacturer actually demands you sit on $500,000 to $1 million in pure liquid capital, totally untouched. You are literally millions of dollars in the hole before a single car even rolls onto the lot. Part 2. The floor plan trap. So when the doors finally open, the dealer obviously needs inventory. But here's the catch. They don't actually own those shiny new cars sitting out there. They use something called floor plan financing. Think of this as a massive high-stakes credit card, specifically for cars. A bank, or the manufacturer's own lending arm, fronts 95 to 100% of the wholesale cost for that inventory. The dealer gets to hold the metal, but the bank holds all the financial leverage and a risk. Because of this setup, unsold inventory is literally a ticking time bomb. Dealerships bleed an estimated $40 to $85 in holding costs and interest every single day a car just sits there on the pavement. Think about it. If a dealer has a slow month and 100 cars sit around for just 10 extra days, that's up to $85,000 evaporating into thin air, with absolutely zero extra revenue to show for it. Part 3. The real profit engines. This is where the magic happens. This breakdown is the absolute core secret of the modern dealership. The car itself? It's just the bait. The real money is actually made in the back. Selling the actual car on the front end only accounts for about 13% of the gross profit. Fixed operations, which means parts, service, and the collision center, pulls in a massive 50%. And the finance room captures another 37%. Let's talk about that finance and insurance room, the F&I room. It's essentially a hidden business. They quietly pad your loan with dealer reserve, which basically means marking up the bank's wholesale buy rate. When you finance through them, the dealer gets a wholesale interest rate and legally marks it up to pocket the difference. Then, they pitch you warranties and gap insurance at mind-blowing 50 to 200% markups. But here's the craziest part. Those warranty premiums often get funneled straight into tax-advantaged offshore reinsurance companies in places like Turks and Caicos that are completely owned by the dealership. It's literally a second, highly lucrative business running entirely in the background. But the real financial anchor is at service bay. For dealership owners, the most critical metric in the world is the service absorption rate. The goal is for parts and service to cover 100% of the entire building's overhead. The industry actually targets 115% absorption rate. If they hit that, every single car they sell on the lot is pure, unencumbered profit. Car sales are moody. They swing wildly with the U.S. economy. But cars always need oil changes, and they always need brake jobs. That service bay is the beating heart that keeps the dealership incredibly rich during a recession. Part 4. Rigging the math. Have you ever negotiated a car down to the invoice price and walked away thinking, wow, I just bought this car right at dealer cost? Well, you didn't. The manufacturer intentionally inflates that invoice price. This lets the dealer negotiate all the way down to quote-unquote cost while quietly receiving a 1 to 3% guaranteed refund check on the back end. That hidden check is called dealer holdback. You might drive off the lot feeling like you won the negotiation, but the dealership already baked their win right into the math before you even sat down at the desk. And this is where the infamous four-square negotiation tactic comes into play. They tangle everything up: your trade-in value, the purchase price, your down payment, and your monthly payment. Dealers prey on the fact that most Americans just want to hit a specific monthly budget, so they manipulate the loan term to hit your target payment while quietly driving up the total interest and fiercely protecting their own margins. They'll happily starch a standard 60-month loan into an 84-month loan just to give you that magic monthly number, which massively inflates the total interest you end up paying. Part 5. The Dealership Empire. To protect against major risks like shifting interest rates, the absolute most successful dealers don't just stop at one lot. They build multi-store empires. This multi-store strategy is genius. It consolidates overhead by sharing HR, accounting, and software costs across the board. It totally diversifies their risk across different manufacturer brands. So if one brand has a bad year, another picks up the slack. But most importantly, processing thousands of warranty contracts a month across multiple stores massively scales up that offshore captive insurance pool we talked about earlier. It turns into a compounding wealth machine where the investment returns absolutely dwarf the profit of the physical showrooms themselves. So, when you break it down, what does the owner actually take home? Their official salary, which usually sits between $112,000 and $177,000, is just a tiny part of the illusion. That modest salary is ultimately dwarfed by everything else. The owner usually holds the physical land in a totally separate company and charges their own dealership premium real estate rent. Add in the standard profit distributions from the lot, plus those millions in untaxed dividends compounding from the offshore warranty pools, and you are looking at a massive, multi-million-dollar compensation package hiding right under our noses. It all boils down to this: the car was never really the product. It was just the entry point into a highly leveraged machine, built from the ground up to extract profit from every single stage of that vehicle's life. So the next time you drive past a massive, glittering auto lot in your town, ask yourself, who is really paying for that empire? And what other local businesses are hiding a multi-million-dollar offshore secret right in plain sight? If you found this explainer insightful, please hit that like button, drop a comment, and make sure to subscribe. Thank you so much for joining me, and I'll catch you in the next one.